The following session is not to be treated as personal advice. MyFX Plan provides general advice only. That does not take into account your personal objectives, financial situation, or needs. Trading FX and CFDs involves a substantial degree of risk and should only be undertaken with risk capital. Investors do not own or have rights to underlying assets.
Welcome traders. In this walkthrough, we'll go through how volume is not where the risk is where the stop loss is. So we'll take this trade as an example. By trading off the key level, we saw that's where the day opens here. And we saw a bit of a movement and a pullback from a resistance into or nearing actual pivot point, and then a strong movement to the next resistance point. Looking at this trade, a trader could have entered here on that bullish candle, we can see, just above that line we drew. And we're going to mimic this trade on the open position calculator by putting our stop loss where a trader may place a stop, which is underneath the pivot point, and also the take profit, which is a place where a trader may put their take profit underneath that resistance one, and also that high that's previously made 3 hours before the entry point. So now we're bringing up the open position calculator by clicking and dragging on your chart and pressing yes, and then OK. When the calculator does open, make sure you are selecting the current pair you're trading. Once you have done so, we can enter the values that we've put on the chart here. And as I want to actually mimic the trade, I'll be putting a bending buy on here and the price we've entered here, you can see there. And that's going to mimic what the trade would have looked like if you were to buy at this level. Once that is in, you can put the stop loss in. Same thing going back to your chart underneath that pivot point. And then after that's done, we're putting the take profit, which again is underneath that resistance and also slightly underneath the recent high that was made. Now what we have here is a trade. So you're risking just about 11 pips to make a total of 32 pips if this trade does go for you in the right direction. And of course, this is where the confusion comes in. The very last thing you need to do on every single trade, because the trade doesn't change, is change the volume, because the volume will be changing relative to how much what you want to risk on your account, which is usually a percentage of your account balance. To practice and make things clear, we'll go through 3 examples now of trading accounts. In all these examples, we'll use the exact same trade we saw on the chart. The stop loss here is 11 pips and the take profit is 32 pips. On this example, the account balance will be $1,000. We'll take a 5% risk again for another example, which will equal to negative $50 on every single trade. The calculator, using that one on the platform, the volume needs to be 0.35 to make that risk negative $50. In terms of dollar amounts, the loss is negative $50 and the take profit is $139 if the trade goes in your favor. Let's see what it looks like on MT4. With the calculator back up on the screen, all we need to do now is actually change the volume. You can see it's the exact same trade. 11 pips for 32 pips take profit. So we're going to increase this one once we see a negative $50, which will be 5% on a $1,000 trading account. You can see again on the right hand side, it's the exact same trade, placing it on those pivot points. Okay, the second account example we'll go through is going to use the exact same trade, so 11 pip stop loss for a take profit of 32 pips. This account balance is now $10,000 for your trading account, the same risk, 5%, but now it's going to be negative $500 on the actual trade. Using the calculator, the volume needs to be 3.50 lots for that risk to be $500. In my true value, the risk is negative 500 for a profit of 1,390 if it goes in your favor. See what it looks like on MT4. With the calculator back up, you can see it's the exact same trade, 11 pip stop loss for a 32 pip take profit. So now, because the risk is $1, we're going to increase that to negative 500 to make that trade 5% on a 10K balance. So we're using the arrow here to increase in the volume until we see negative $500 on this trade. Again, just to make it clear, because this is where the confusion lies, it's the exact same trade. You're placing on either account and you're changing the volume for the risk. The last example we'll go through is a much larger account. This account balance is $100,000. It's the exact same trade, stop loss 11 pips for a take profit of 32 pips. The percentage risk is the same, 5%, but the monetary value is negative $5,000. Using the calculator, the volume needs to be 35 lots for that trade to be negative $5,000. In terms of monetary value, your loss is negative $5,000 and your take profit, if it gets there, is $13,900. Let's have a look at what it looks like on MT4. So we're back on the calculator. Again, it's the exact same trade, 11 pip stop loss, a 32 pip take profit. We need to now change the risk. Another way of actually changing volume is you can type it in manually, like I'm doing so now. You can choose a random figure and then eye off where it needs to be. So if that's 1.4k at 10 lots, I can put in 40 lots now and see what that is. That's close to 5,000, so I'm going to actually drop it down to 35. And you can see there, it's right on target, which is 5% on a 100k account. We know the trade doesn't change, the volume changes. It's about the equity in your account. So let's take a look at what I mean. You can see in those trade examples we went through, it doesn't matter how much you have in your account. What matters is you're doing proper risk management and capital management. If you're selecting 5% on your one trade, then you're taking a portion of your account. You're defining a risk. What does that mean to you? It means that actually you're splitting your account up in portions. So if you're doing 5% on one trade, 2, 3, 4, 5, all the way down to 10, then you're using 50% of your account, which means you have 50% left sitting there doing nothing. And of course, correlations come into play when you're trading, but making use of your equity, doing proper risk management and proper capital management, you're building your account. It's all about having the right mindset because you will take losses. Having those attractive risk-reward ratios, overall, if you are getting trades right, you can be net profitable. And as always, thank you for watching.
Take the next step to financial freedom with myfxplan.com. Exceptional service perfected.